we are starting our live stream, and before we start, I need you to read that important disclaimer. We have actually 2 pages of that disclaimer. We cannot miss it. Okay, thank you so much, and let's begin. We always start from the 5-wave up fractal, because the Harmonic Elliott Wave Theory is actually a tool which is based on a collection of fractals. And the main idea behind the wave analysis is just to identify where the current market is in according to that fractal. So we need to correctly identify the fractal, and then we will be able to follow that fractal for weeks. And because fractal actually predicts the next move, we can be accurately forecasting it. Okay, and we are going to start with ES Mini, and we will be talking about the top made in February 2020 and the correction that followed it. And this is the daily chart of ES Mini, which covers the 11 years, and I do not show you the beginning of that rally, which started in 2009, and you can watch my video on YouTube, posted on YouTube yesterday, if you want to see more details. We will be focusing on that actual drop that happened of 3,400 and bottomed around 2,200. That was a very strong and quick drop. And as you can see, I count that top as wave 3. It's shown in parentheses because it highlights the order, the degree of that wave. And here you can see that we can easily count 5 microwaves, 1, 2, 3, 4, and 5, because this is subwave C of 3, the strongest part of the rally, the second leg up in wave 3 up. And here we need to come back to our fractal and to see basically what normally happens when a major wave 3 tops. And as you can see, it topped in February 2020. We normally get a large corrective wave 4 down. This is it, and normally it is subdivided into ABC, a corrective fractal. And what's very important here, what we should understand, according to the Harmonic Elliott Wave Theory, that wave 4 down needs to make a higher high in comparison to the previous corrective wave, and the previous corrective wave was subwave B inside that wave 3, and it made the low 1788.50, and it's very important, very critical low. As long as we hold over that low, we can expect continuation of the rally. That would mean that the top made in February 2020 was not the top of the market of the rally made in 2009. That would, as long as we hold over that critical support, we can expect continuation of the rally after completion of that first of that ABC move down in a corrective wave 4. What we would expect is that the first leg up in subwave A of 5, which has to stop somewhere around the top made in February 2020, then pullback, and then another push higher, which has to make a new higher high. Again, if we hold over that support, we still can expect that the top made in February 2020 would not be the ultimate top, and the market would continue going higher after completion of that pullback. So then the critical question for us, whether we can consider that first drop down, very deep drop down, the final, whether it was like the whole wave 4 or only the first leg down. And this is what we are going to discuss. To do that, we need to zoom in into that particular fractal, that the substructure of that wave 4. And as I mentioned, it should be subdivided into ABC. And if we zoom in, we are going to see a specific segment of the whole fractal. That ABC, that fractal, the model of a corrective wave 4 down, is just a part of a bigger 5-wave up fractal. And this is what we keep doing all the time when we try to navigate a corrective move. we can not work with a macro 5-wave up fractal. We would zoom in and we would be getting more details, and that model would help us to predict the next move, and not only the next move, but what's gonna next after every small move. And we can count those microwaves in order to understand when, for example, that move is big enough to be considered complete, and when we can start expecting a continuation of the move down. So as you can see on that chart, of the model fractal, I think that in February 2020 we got the top of wave 3, major wave 3, then we got ABC move down, but the problem is that wave 3, as I've shown you before, it was a huge wave 3. This is just a part of that. It started in 2009, and if it topped in February 2020, that would mean it lasted for 8.5 years. When we got such a beautiful big drop, sharp drop, it lasted for a month. I really do not think that's enough. And in majority of cases, when we look at that ABC down fractal, that A normally is the strongest part of the move down in terms of technicals, meaning that it could come as a sharp drop, then we would get a corrective structure up, and that kind of second leg down would not be as strong in terms of a slope of descent in comparison to the first drop. It could be kind of a slow decline which could last for several months. So let's come back to the actual chart of AS Mini. It's a daily chart, and we will keep changing from higher time frames to lower time frames, because the harmonic Elliott wave theory actually is based on fractals, meaning that if we come back to that fractal of the 5-wave up fractal, we can see that we have several blue segments here where bulls push price higher, and those are called impulsive waves. And inside impulsive waves we have 5 waves up, and I've just shown you a very good example. So look at that subwave C of 3, and now we can check the actual chart, and we can get 5 microwaves inside that subwave C of 3. So if we keep zooming in, we can micro counting those smaller waves which together comprise bigger waves. For example, if we want to check wave 4, we know that wave 4 is subdivided into A down, B up, and C down, where, for example, A down can be subdivided into smaller ABCs. B up is another smaller ABC, and C is a very small 5-wave down fractal. Here we have 5 waves, and this is why we call it 3, 3, and 5. The structure is called 3, 3, and 5. And on a larger scale, it's like 3, 3, and 5. Let's continue. So we got that sharp drop, and I do not think it was long enough. It was deep enough, actually. It was deep enough to be considered the whole wave 4 down. And this is why I think that many traders would believe that that was the whole corrective move down in wave 4, and now price could continue moving up. The problem is, again, it lasted only 1 month, and when you think about whether a corrective wave bottomed or not, you should pay a lot of attention to the sentiment of the crowd. I don't know about you, but I got so many calls from my friends who are not professional traders, and all of them wanted to buy stocks. And when retail traders, all of them want to buy stocks, it's a very bad sign for the ultimate bottom. When ultimate bottom of a large corrective wave comes, nobody wants to buy, especially on retail side. It's just very important sign you should always pay attention to. So if we assume that the first move down, that ABC, was only the first leg down in subwave A, you see that A, which is labeled in parentheses, we can assume that according to our fractal, we need to get ABC up before we get another leg down continuation of the move down in the final subwave C of wave 4. Then we need to identify that ABC up inside that corrective wave B, and it's not very difficult. So basically we can easily identify A up followed by B down, and that means we are somewhere in the final subwave C of that wave B. What I mean is that if it was done and that was done, so then we are somewhere here. Then we need to apply several tools to find potential reversal zone for that corrective move up. I call it corrective because the main direction of that corrective move down, bigger corrective move down in wave 4 down, is down. And that wave B is very difficult to trade because here the whole structure is corrective, because remember, on a weekly chart the trend is still up, but we have a temporary interruption in the trend in the form of that pullback, and it comes as ABC down. But inside that ABC down, wave B is kind of interruption in a pullback, which itself is interruption of the trend up. And this is like a battle of bulls and bears, and this is why in many cases it's very difficult to trade it, because when we deal with a trending move like 5 wave down here and 5 wave down here, there is a prevailing force here, so it's red, so bears are prevailing force, they keep pushing price lower, and you can see that every push down makes lower prices. When you have that B of B, you can see that that structure is overlapping. We go up, we go down, and we almost make new lower lows. Very difficult to trade, but it's still possible. Because that wave B itself, B up, is a reaction to the first drop, first what we do, we apply retracement ratios, those red fips. And for example, we can see that last Thursday, we actually managed to retrace 50% of the whole drop, and this is a meaningful level. The problem is it's too cheesy. Everybody knows 50%, and this is why in majority of cases it does not work as a strong resistance, because everybody knows it. I much more than that, I like two other levels, 58.6 and 66.7. You may know that I have introductory video course, and in that video course I have several chapters where I explain where Fibonacci numbers came from, and I also explain additional ratios that work well, like Z1 58.6 or 41.4. Not many traders actually know them and use them, but you can derive them from square root of 2, just like a teaser for you. So I would recommend you to try that video course, so you would better understand what I'm doing here and you would better understand my methodology. Okay, we got that first levels to work with. Then what we do, we apply projection tool, because in any ABC structure, subwave C relates to subwave A in a number of specific extensions, which I also explain in my introductory video course. We add 3 common of them, like 76.4, the bare minimum one. Normally, the final subwave C in any ABC gets longer than the first push down. For example, look at that ABC. That C is clearly longer than that A. So we measure that distance, we project it from the bottom of that corrective push down, and we get those 3 blue fips, 76.4, 100%, 123.6. The trick is we use different tools. We have just used retracements, now we use projections, but look how perfectly they are aligned. They point to the very same levels. Not every time you have it, so that add meaning to those levels. Those levels are meaningful resistance levels. In addition to that, we could add, for example, major moving averages, like that green one. This is 50-day moving average. And look, it's coming to the very same level, so it adds importance to that level. So around 2880, we have a very strong resistance. In addition to that, when you watch move up, many traders will watch where the previous pullbacks stopped, like here. So those two small wicks on daily charts, you see those wicks like shades on top of those candles, mean that inside those days price went higher, but then it got faded. And basically those are signs of supply zones. That means that over the top of those candles, of the body of the candles, where you have those wicks, you have supply sitting there. So there are sellers who are willing to sell at those levels, and we are talking around maybe like 2860. You can check it on a micro time frames. But what I personally found, what actually works much better as resistance for such pullbacks, would be pivots made by on the way down. So I would look at that level, at that wick. This is where price kept moving down, down, down. It dropped under that level, under 2880, and then immediately popped up. And look, next day it opened lower again and it got bought out. So you can imagine that that level is psychologically important, and there were a lot of bids, a lot of orders from traders which got unfilled. And that level, even though we have like 1 month passing then, it's still important. So that again, that 2880, that level where where the first drop found support, is still super important. This is where we got that pop, and this is where that move up could stop. Now, when we watched that fractal, we discussed that move up in B up should be structured as ABC, and normally when you deal with ABC, any corrective ABC, the final subwave C should be subdivided into 5 microwaves. Look, 1, 2, 3, 4, and 5. It's so-called an impulsive structure. When we have those levels, and even if we are aligned, it's basically only the first step in a task where you need to find a potential reversal zone. The next step would be micro counting, meaning that if you know that subwave C, the final of subwave C, has to be subdivided into 5 microwaves, you have to identify those microwaves. The problem is daily chart is not great for that. It does not let you count those microwaves. You don't see them here, and the only way for you to see those microwaves is just to switch to a lower time frame. So let's switch to a lower time frame. That would be SPY 45-minute chart, covering the period from March 20 until April 20. So now you start seeing more details. You can perfectly see that A up. You see it's like a one push higher. We can count it as an impulsive structure. Then we get a corrective ABC down, which itself comprises subwave B of a high degree. And then we have 1, 2, 3, 4, and 5. So we can see that we can count that microstructure in SPY inside subwave C as completed. And the great thing is that it has already tagged the red target box. So from this point, it does not make sense to be long, I would say, because corrective move down can start at any moment. And at the same time, you can see that the red target box suggests that that move can stretch a little bit higher, for example, to that 100% extension. So the very same 100% extension worked for both ES mini and SPY. In addition to that, you can see how important is that level, 289 for S&P. That level stopped with the first move down, the one we discussed for ES mini, but look what happened then. When it dropped under that level, it came back and twice retested that level and got rejected both times. That actually adds a lot of importance for that. Now we can look at ES mini on the micro chart. Remember I told you we need to be able to count 5 microwaves inside that subwave C before we can count that wave B up completed. And here you can see I added those micro labels 1, 2, 3, 4, and 5, and it's tagging that red target zone. Not only that, look at that supply zone here. Again, you can see here a micro reversal. It reversed here. You see it tested that level twice. We are talking about 2880, the very same level that stopped the decline. So that adds importance to that level. And then it makes first micro push down, comes back up, and look at that wick. So we are talking about 2-hour chart. So that is intraday reversal. And those orders are still sitting there. Those are people who got actually trapped on that pullback. They may still hold some of the longs, and we still watch that level, and this is why we turned off that level on Thursday. But that does not actually mean that we cannot stretch a bit higher. Now I want to tell you one thing, is that when you watch topping count in ES Mini, it always makes sense to switch to NQ and QQQ, because normally count in Q is cleaner, and this is what we are going to do now. This is QQQ, and if we look at QQQ, we see a little bit different picture. Yes, we have the very same A up, we have ABC of B down, and we have an impulsive structure of the final push higher in subwave C of a larger wave B up. But as you can see, that particular fractal does not look completed. So to complete it, we still need to complete that microwave 5 that starts from here, and it should be subdivided as A up, B down, and C up. QQQ, actually looking at the micro count, may stretch a bit higher, specifically to 208.40, or maybe even a little bit higher, and we can see that QQQ actually has already tagged 50% retracement of the whole drop, but we still can get it a bit higher to 58.6, and a very similar picture could be found in NQ. This is NQ 9000 tick bar chart, also covering March 20, April 20 period. The problem is subwave C, that one, cannot be counted as completed by now. Microwave 1 up, 2 down, you see perfect ABC up, ABC down, ABC of wave 3, ABC of wave 4, and here we got a lot of whipsaw. That could be A, ABC of B, and I do not think that small push higher was all of subwave C. We should get full 5 microwaves, and that would be 1, 2, wave 3, 4, and 5, which points to a very similar target, which is 100% extension of that first leg up in subwave A, and that would give us something like 86.50, 85.50. Let's see, and if NQ drops under that support, it's 8101, and if QQQ drops under 195, and if ES drops under 2630, and if SPY drops under maybe 2262, that would be the first sign that the whole structure got completed. But as long as we hold over the low made by the previous micro pullback in the microwave 4 down here and here and here, we still can expect continuation of the move higher. And frankly speaking, again coming back to the sentiment, we see that too many traders are looking to short that rally, and the best completion of a large corrective wave B up would be some kind of acceleration move up at the very final stage. This is where a lot of traders would start doubting their conviction that it was a corrective move. This is when we should see a lot of focus saying that, you know what, forget it, the first drop down was all of wave 4 and we are watching a new rally, so we are missing out, let's catch up. This is what can happen if price goes over that level, over that microwave 3, and you may remember we discussed in my previous video lesson how we got that very strong CO5 on March 3rd this year, when we got that surprise interest cut and price went up parabolic. It all lasted like for 10 minutes. And this is actually what can happen here, because we are talking about micro. You see, that move actually took like 1 day, and that whipsaw took 1 day. We can get another move up which could last one day, maybe 2 days. This is it, maybe even half of the day. But if we get that very strong, almost vertical move up, maybe on that OPEC Plus deal, that could be a great sign that it's stopping, and that would be a classic top for the corrective wave B up. Just to remind you, I have 2 video courses. That video course is the introductory video course. This is where I explain you the main fractals and the main patterns. This is where I would recommend you to start if you never learned the Harmonic Elliott Wave Theory. Even if you studied and even if you applied the classic Elliott Wave Theory, I would recommend you to take that course, because the Harmonic Elliott Wave Theory has a number of differences. And once you actually study that course, once you complete it, then you need to go to the pro course, because that course would use the very same collection of fractals, the very same collection of patterns, but it will add more details, because I did not want to make it too complicated for beginners. I want them to start with like simple thing, and then step by step we will be complicating things. Let's now talk about crude oil. If you want to get my conclusion about the US indices, I believe that it makes sense to start building a short, and I believe it can stretch higher, and the higher it gets, the shorter shorts you can make. I mean, for example, on Thursday I started puts, 3 months puts. I just wanted to have more time in case it extends higher, but the higher it goes, the shorter you can take your puts. So basically at that point you can start buying like 2 or 3 weeks out, maybe 3 weeks out. Thank you very much for your time. I really appreciate it. Please subscribe to my YouTube channel, and that would mean a lot to me. And please like this video. Have a great weekend. Bye.